Welcome to our channel. I'm Nolan Brooks, proud founder and broker of Brooks Realty Group. Whether you're buying, selling, or investing in real estate, we're here to guide you every step of the way.
And I'm Madison Alexander, a licensed real estate agent here in the state of Missouri. Subscribe to our channel for more tips, tours, and real estate insights. Today's topic is going to be advice to new owners, specifically building your box.
So what we mean by building your box is establishing your criteria. Not every deal is going to be right for you. So there's certain considerations you need to think about before you accept or start working on a deal. So the reason I use the example of a box is you construct a box, and a box has certain limitations. And if a deal doesn't fit into your box, you shouldn't be considering the deal. So for me, I personally am looking for a house or a multi-unit property built after 1978 that was designed to be multi-unit. So if it's a conversion, a single family that's been converted to a multi-unit, I'm not interested. That doesn't mean it's not a good deal. It just means it's not a deal that I'm looking for. So Madison might be looking for a very different deal. So for her, a single family property that was converted into multi-unit might work for her.
Right.
So the more you learn in real estate, your box is going to change over time. And the irony is that the more you confine your box, the more deals you're going to make and the more money you're going to make, because it'll make it easier and easier to eliminate all these different deals that don't work for you. So you might ask, well, what do I need to take into consideration when I'm building my box?
Right.
So the first thing to think about is, what are your skills? So Madison, what skills do you feel like you have that you could bring to investing in real estate?
Right. So like my skills, I would say would be more like the marketing. I can do staging and stuff. I don't know anything about renovation. So like for me, getting a property that's already, kind of ready to go is looking a little bit better, maybe, or hiring out some help if need be. And then taking that over, and I can handle more of like the marketing and that kind of stuff I feel more comfortable with, and like making it look nice. I can do painting, I could do all of that, but I'm not ripping anything down to studs.
Right. So when you are constructing your criteria for your box, one of the things that you're going to look at is, what are you going to have to pay other people to do to get it rent ready?
Definitely.
Or are you looking for something that's already rent ready?
Yeah.
So, whereas for me, I already have a large network of contractors that I know because I've been doing this for so long, and I have some knowledge and experience with renovations on my own.
Right.
So I might be willing to invest a lot into a property that it would be a good deal for me because I see the possibility of sweat equity, whereas you see dollar signs because you're going to have to pay contractors to do all of the work.
Yeah, definitely.
So when you're evaluating the deals, that's going to be a major consideration for you.
Figuring out what your skill is, I think, is definitely important.
So with your skill set with social media and marketing, you might really be optimized for finding deals.
Right.
And then putting those back out there once the work is done.
Yeah.
So maybe it's a fix and flip that works better for you. And we'll get into that here in a little bit, but I would be on the other end of the spectrum. So the next thing we need to consider is, how involved are you planning to be in this real estate investment?
Yeah.
So if you're looking at doing the repairs and management all on your own, it's not easy money. Like you're going to have to put in work. And anyone who tells you that you won't have to put in work, that it's just mailbox money, they haven't been paying attention or they don't own properties.
Yeah.
Because you're going to have those 2 a.m. calls, you're going to have sewer backups, you're going to have to find tenants, you're going to have to schedule maintenance, you're going to have to do all of this stuff. And if you're comfortable with that, then great, wonderful.
Definitely.
That's what we do. So, like, if that's your thing and you're comfortable with that, that's great. But if you're not comfortable with that level of engagement, let's say you want to own it and forget it, then you're looking at a property that's managed by someone else, which, quick plug, if that's what you're interested in, if that's what you're looking for, even if you just want advice, please reach out. We'll be happy to give you our advice, even if you're not in our market. But, knowing that on the front end is going to really help you avoid a lot of mistakes on what property you're going to get into. Because if you have to do a full reno, then you're either going to be really involved, or you need to decide to find and hire a general contractor to manage that for you. And knowing that on the onset is going to help decide what properties and where you're willing to buy and that kind of thing.
Right.
Because if you're going to be doing all the management, then I strongly recommend that you keep those properties close to your house. Like where you live.
No kidding. You don't want them all over.
If you're trying to manage a property from 1,000 miles away, it's really hard.
Yeah.
And you're really vulnerable to being ripped off by contractors. So just keep that. These are the considerations you need to think about.
For sure. Yeah, and then the next thing is just kind of figuring out how you go about paying for a property like that.
Right. So when you are looking at your property, financing is going to play a really big role in what property you're going to choose.
Yeah.
So if you have cash, man, you can buy whatever you want. Sky's the limit as long as you have the cash for it. So that's on one extreme way over here, right? But then on the other extreme is you have government loans over on this side over here. And government loans, they're wonderful because you can get really good rates. Typically, though, you're going to have to live in it. But with a government loan, you can live like this is like FHA, rural development, and VA. They're wonderful. You can buy a single family all the way up to a fourplex, and I help clients do that all the time. But you have to live there. So
for I think a year, right? You have to live there for like a year.
It depends.
Oh, okay.
So I'll use VA for example. If you buy a property and you move in, and then you get orders to somewhere else, like military orders, you don't have to stay there.
Oh, okay.
Like you can rent it out, but you lose your VA eligibility for a year, so you can't buy another house without going through a certain process with the VA. Which it's still doable, it's still possible,
right?
But you have to document why you left. You have to provide proof, all that stuff, and talk to your lender. They'll be the subject matter experts on that kind of stuff.
For sure.
So if you're looking to do a fix and flip, it's probably not going to qualify for those. Because the condition of the property is probably not going to be up to the standard of like a rural development VA or
because they have higher standards.
Exactly. Now, a conventional loan is kind of somewhere in the middle, and that is where you put a certain percentage down, usually 20%, not always. Talk to your lenders. And if you're doing a conventional loan, you put down that percentage, they do the rest, and that's going, the guidelines and limitations are a lot looser, but you still have, the property has to appraise for whatever you're purchasing it at. So as long as it appraises for that amount, you're probably okay, but again, talk to your lenders for details. Then there's renovation loans where you buy a property and then they give you the amount you need for the purchase, but there's also a draw that you can take from the bank to help finance the renovations. And then at the end of that process, they do another appraisal. You'd get they refinance the whole thing, and then it's in a 30-year fixed or something.
Yeah, I have a question. My dad was talking to me, so he just bought a house and he's
Right.
getting a VA loan. And he had said something to me about how after they're done with all those repairs that they're doing at the house, they're going to have it like reappraised and then they like get money back or something. That's what he was saying. And I was like, I have no idea what you're talking about right now.
So it really depends on the loan type. Because, for instance, with a VA, you can do a 100% cash out refinance.
Okay.
But generally, you can't do 100% cash out refinance. You'll get a percentage. So let's say 70 to 80% back. So, and this is a little bit off topic, but it goes into like the Burr method and whatnot. So what you do is you buy a property, you renovate it, they do that appraisal, and then they figure out what your equity is. Right. So they take the appraised value, subtract what you owe on it.
Right.
And the difference between that and 70% of the value of the property.
Okay.
I know I'm rattling off a bunch of
I think.
So you have, that's what you get out of it.
Okay.
So really simple example. I'm doing it off the top of my head, so please forgive me. So we buy a $200,000 house. Correction. We buy a house for $100,000.
Okay.
We put $10,000 into it.
Okay.
So we're now in it for $110,000. It now appraises for $200,000. Okay.
Okay.
So we owe $110,000. It appraises for $200,000. So we can get up to 70% of that in this case, right? So that's $140,000. So you subtract $110,000 from $140,000, and so $30,000 is what you could get out cash to do other things.
That is so crazy.
Yep. Now that's all part of the Burr method too, which we can do a whole video on. But that's not taxable income because it's offset by debt. So you didn't make money.
Right.
You got a loan for that much money, so you have to pay that back.
Right. Okay.
Plus interest. But what investors will do is they'll do that, and then they'll buy another property and repeat the process.
Money to start repairs, basically.
Right, on a new property or purchase.
Yeah, because I think that's not my dad's plan exactly, but to use that money to finish up and do some more repairs on the house, I think.
Right.
Something like that. I don't know. Love you, Dad, but I wasn't really paying attention.
Sorry, that's funny. So another thing you need to keep in mind is what's your timeline?
Right.
So I am what you would call a buy and hold investor. When I buy a property, I mean, there has to be something pretty major going on to get me to sell that property to cash out, right?
Yeah.
I would much rather do a cash out refinance or just keep it forever and cash flow off of it than I would to sell it and cash out that way.
Right.
That way I can avoid taxes and some other things. Pardon me. So, your lending will dictate some of your timeline. So if you do a purchase and your lending says you have to keep it for at least a year, for instance, that means buy and flip is probably not great because you have to hold it for that entire year until you can sell it again. Doesn't mean it's out of the picture. It just means you need to take that into account because you have 1 year worth of holding costs in addition to the repairs. Exactly. So another thing is that you may have a timeline where you have what's called a balloon payment. We won't get into it on this one. That's more of a financing video. But a balloon payment in brief is where you have to pay a big balloon payment at a certain time, and then you basically have to pay off the loan all in one big chunk.
Right. It's like you have, your normal regular payments and everything, and then at the end of your loan, a big balloon, and you have to pay all of that.
So for instance, you could do hard money on your financing. Well, a lot of those have balloon payments where they say, okay, I will give you the money to buy this, do the renovation, but in 6 months you have to pay off the loan.
Right.
I don't care if you refinance it and do it that way, and I don't care if you sell it, but in 6 months you have to pay me the full amount of everything I lent you plus interest.
You said hard money. What is hard money?
So hard money, think hard money is like from a private, non-institutional lender. So if you have an uncle that has a big pile of money that he's sitting on,
right.
Just wants to, you know what, I love you. Here's the rules. But there's certain people out there that they make their money this way. They can there's certain rules on that they have to follow, but it's a lot more flexible than like a Fannie Mae Freddie Mac mortgage loan. They're not loan sharks. They know some. So that's hard money. It's someone that has money that they're willing to loan out. Typically, you're paying a higher interest rate. Typically, it's a shorter term mortgage.
Gotcha.
Or not mortgage, but shorter term note. So, any questions on that?
No. I think I'm getting that one.
Okay.
And that could also be something we expand upon more in, like you were saying, like a finance video too. Just kind of go deeper into that.
So all of this is stuff that as you build your box, you need to keep in mind. So one of the other things that you need to keep in mind is the actual specifications of the house. So if you remember, mine it has to be built after 1978. So why is it important that I want it built after 1978?
Because of lead.
Lead-based paint. That is correct. Yeah. I don't want to mess with lead-based paint because lead is bad, I guess.
Because lead is bad,
I have 4 kids and I don't need them eating lead paint chips. So
yeah, probably not.
Yeah, let's not do that.
I don't think Kat would be really happy about that.
But more honestly, it has a lot to do with how expensive it is to remediate lead-based paint, if you want to comply with the federal lead regulations, it can be cost prohibitive. So I just avoid all of that by not investing in real estate that was built pre-1978, right?
Makes sense.
I'm looking for multi-unit, but not converted single-family to multi-unit.
Right.
Why would I want to do that? Well, generally with properties that are built to be multi-unit, they're built with separate meters for water, electricity, gas, all that stuff.
That way you don't have to cover that.
Exactly. It means I don't have to cover it for the tenants, and it means less risk for me.
Yeah.
Right? I don't want to have to be in the process of evicting someone but still required to pay for their sewer because there's 2 other tenants that are paying that are using the same sewer. Does that make sense?
That would suck.
So, condition. I'm not afraid of doing a remodel.
Right.
I've done it before, and I'm certain I'll do it again. But I would prefer if I have my, my druthers, I would have turnkey. I'd have it already renovate in good enough condition that I could rent it and then turn 1 unit at a time. Right.
Right.
But that's me. I know of another owner who, when he buys a multi-unit, he gives everyone notice that he's not going to renew their leases. He's like, nope, he buys stuff that's really rough condition.
Oh.
He gives everyone notice as soon as he takes ownership that at this, when your lease is up, I'm not renewing your lease. But then he comes in and he renovates everything all at once.
Nice.
And he makes everything nice. He just gets it all done.
Yeah.
So he's not having to do this
slowly, bit by bit.
Slowly, bit by bit thing.
Yeah.
And that way he can get rid of all the bad tenants and start fresh. And he doesn't have to deal with baggage from somebody that might be, causing problems.
Right. That makes sense.
Because bad tenants cost you money.
They do.
And the idea of having a box or criteria also applies towards your tenants, although that'll have to be a different video.
For sure.
So is there any questions you have about kind of building your box and considerations for the box?
One thing that you had mentioned to me, like, because the biggest thing for me, I think, is going to be financing. That's what I saw. As you could probably tell, I'm not that old. So I don't make that much money right now, and I'm not super familiar. I've never bought a home or anything like that. And so it's like, that's the biggest concern for me. But I remember you had mentioned something to me a while back that I wanted to bring up, is that when you have you buy your first, like, duplex, for example, then you go to buy a second one, say you've lived there for a year, and you go buy a second one, you can, forgive me if I'm wrong, but I thought you had said something about using the income, like if that one already has a tenant in there, using that income towards paying for the loan. Does that make sense? So, like,
Yes.
you tell your lender, say, oh, this property will make me this much money, and they can use that, so that would help you qualify for the loan?
Yep. So please don't sue me.
Please don't
Please
sue
consult your tax professional and your attorney.
me.
Okay.
Right.
So, in my experience, as long as you have been managing a rental for 2 years,
Okay.
and it's on your taxes, so it has to be on your taxes for 2 tax years,
Okay.
right? And you're buying another property, then you can use up to 70% of the income from that property to assist you in qualifying for the loan.
Okay. That's interesting.
Yeah.
Yeah.
So there might be some caveat on that about being a real estate professional, but I've been a real estate professional since I got out of the Army. So, since I've been in my professional life out of the Army. So to the best of my recollection, that's what it is. It's I'm not certain about being a real estate professional, but you'll have to look into that if you want specific guidelines on what qualifies as a real estate professional. But I know for me, because I'd been a property manager for over 2 years, or I had 2 years worth of real estate rent income on my taxes for more than 2 years, that allowed me to use the income production of my next property to qualify for the loan.
So with that, was a tenant already has to be in place there, or is it, oh, a tenant will be there, and this is how much I think it'll rent for? Or does there already need to be a lease, and you need to buy that property with that lease already on there? Does that make sense?
So in the example where I did it, there was already a tenant in place. So that, to the best of my knowledge, that applies.
Okay.
But I don't know if they would let you buy it on projected rents.
Right.
If they do, I would suspect that your underwriting requirements would be much stricter on something like that.
Makes sense.
So, because they would want to. Another thing that you're going to run into as you start accumulating properties is that you're going to have more and more money in reserve to handle, like, busted HVAC units, flooding, that kind of stuff. So, as a general rule, you can only have up to 10 mortgages at a time. There's
Makes sense.
Trust me, you'll learn a lot about that before you ever get there.
Yeah.
But as you start picking up more rental properties, I found that I had to have more and more money in reserves in case I needed to do a new roof or HVAC,
Right.
because they wanted to make sure that I was able to actually maintain the properties in addition to own them.
Okay. That makes sense. So you have to have a certain amount of savings to be
Right.
able to. Okay.
So underwriting does change as you get farther into your career, and that's going to affect how your box shifts and changes over time. So
I was just about to ask you how like over time your box has shifted and changed. Has it stayed more or less the same since when you first started investing, or do you think it's kind of like shifted as you've learned?
So when I first started, my box was yes.
Fair enough.
I would chase anything and everything, and that's how a lot of people start out. A ton of people, most people start out that way. They don't have any type of criteria.
Yeah.
They just know, I want to own real estate. I want to be rich. Let's go buy something.
Money, money,
right?
money.
Money. You know, like Mr. Krabs, you know.
Yeah.
But over time, like I said earlier, you learn that the more you focus in, the more strict you become with your criteria, the quicker you can evaluate opportunities and decide whether they're for you or not.
Right.
So at this point, if I get a property that comes across my desk that's a converted multifamily, because I've done converted single family to multifamily, and that was a headache.
Yeah.
Because the utilities weren't split, because they bodged everything together just to make it work, but not necessarily up to code.
I see.
Like for instance, God, this is actually one from my own place. So for instance, I had a duplex.
Okay.
It was a single family home converted to a duplex. I started getting complaints from the downstairs tenant that the upstairs tenants were making a bunch of noise.
Okay.
And it got to the point where I got a complaint, and I even went over to check just to see what was going on. And they were opening Pokemon card decks and like playing Pokemon the card game, right?
Oh, just upstairs?
Yeah. Not a big deal. Like,
Yeah,
not loud
not a
at
big
all.
deal.
So finally I had enough. I'm like, okay, well, there's only one shared wall. We're going to go in and we're going to add insulation to that wall, because you have you're supposed to have sheetrock, 2x4s frame it in, and then more sheetrock. And then in that gap, you can, where there's air, you can put insulation. So me and my contractor over there, Brad Bromwell, shout out. We go down, and he's going to inject this foam into the cavity, and then it'll expand and fill up the cavity so that we don't have to tear out the wall.
Scared.
So he puts his hole saw against the drywall, goes in, and it just goes all the way through.
Oh.
So when they had been converting it into a duplex, instead of framing in a wall, they just took two pieces of drywall and glued them together.
Oh my gosh.
So the reason they could hear everything through the wall was because there was no wall. It was just two pieces of drywall. Well, I guess that's technically a wall. So
Apparently.
yeah, apparently. So then it was easy. Then it was easy to fix because we knew what was going on.
Right.
We framed in the other side and put another thing of drywall. So now it's got 3 layers of drywall with and insulation in between it. But
Oh my gosh.
But yeah, I would have never guessed that.
Right.
I had a home inspection done. He never there was no way to tell that they just put 2 layers of drywall there.
Good enough.
Yeah, and it was actually the first home my wife and I had ever bought.
Oh, that was your guys' first
Yeah.
duplex? Oh, okay.
Yeah.
Okay.
And but that's why I don't like converted single families
Yeah.
into multi, but that's me. That doesn't mean it's wrong for you or you.
Right.
Because you might have the right skill set to really take advantage of that niche and really turn it into a money-making machine. Whereas I'm like, man, I just don't want to deal with the headache anymore. And I've gotten far enough in my career and in my portfolio where I no longer have to invest in that stuff, right?
Yeah.
So over time, your box is absolutely going to change. Your criteria is going to change. And eventually, it'll migrate as you get knowledge, additional skills, additional resources.
Yeah,
Connections, all. And once you get into it far enough, people will start bringing deals to you. And if you have a very clearly defined understanding of what your criteria is, people will absolutely bring you deals because they can remember it. Because they're like, oh, that's the multi-unit guy that wants stuff built after 1978.
Yeah.
You could remember that.
Yeah.
Right?
Pretty easy.
Where if you're like, I'm into everything, then
You're not going to be the guy that pops up in their head.
Right,
'Cause
exactly.
A lot of people are into everything.
Everything. Yeah, exactly.
Yeah.
And realistically, we don't have enough, none of us have enough resources to do everything.
Yeah.
So you got to narrow it down. You got to build your box. You got to build your criteria. And over time, that criteria is what makes you the most money.
Yeah.
So Thanks for watching. Remember, whether you're a first-time home buyer or an experienced investor, we've got the knowledge and experience to guide you every step of the way. I'm Nolan Brooks.
And I'm Madison Alexander. All of our information is below. Don't forget to like and subscribe. We'll see you next time.